Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by John Bolton, who's the principal of Squirrel Mortgages, which is a mortgage broking firm. But John, we're here to talk about a new venture that you are getting underway, and you have applied for a peer-to-peer lending license, I believe, or are about to.
Yeah, no, we have. I guess we're looking to enter into that peer-to-peer market probably late February 2015, so not too far away. I think it'll take about 3 months to work our way through the license requirements.
And so what is the attraction of peer-to-peer lending for you?
Look, I mean, we're a mortgage broker. I guess it's, to me, we're a reasonably web-based business already. We very much drive a lot of our resources, information, for our clients around the web. Peer-to-peer is a natural extension of that business. And it's, it adds a lot of value to consumers, both in terms of investors and borrowers. So I think it's got really good long-term potential, but I wouldn't want to sort of overstate how well I think it would go in the short term.
What are you going to call the business?
Squirrel Money.
Squirrel Money. Okay, it's great. And obviously you're a person who's worked for one of the big banks before, so you're pretty familiar with how they operate. I mean, how much of a challenge long term is this to what banks do in your view?
Yeah, look, I think the thing is that it's going to take a while, right? This isn't something that's going to sort of miraculously turn into something huge overnight. There's a couple of issues with peer-to-peer lending. If you look at the UK market, the total market size there is about 2 billion Kiwi. And that sounds big because, it is. But they've got a population of 65 million people. So if you convert that back to a New Zealand context, that would be a total market size of around 130 million. And if you take a step further and then you sort of say this stuff is written at margins between, say, 1 and 2%, then it sort of says the total revenue pool for that market sort of in the shorter term is possibly somewhere between 5 and 10 million. In the context of banks, that's absolutely tiny. Banks generate billions and billions of dollars worth of revenue. So it really, really is quite small. And it's a fairly low margin business. It's not like the traditional finance company where they have a 9 or 10% margin. And sure, it's got low platform costs, so it's got a low cost of delivery, and that's what allows this market to develop. But it's going to take time, and because it is a low-cost model, you won't be seeing sort of huge amounts of investment in marketing and advertising. It's something that will sort of build organically through the web. And
what sort of borrowers or what sort of loans are you looking at offering? And in terms of your investors, who will you target?
I think, certainly look, in terms of launching the business, we've kept it pretty simple. The focus is on personal loans, both secured and unsecured. We're looking at doing sort of unsecured lending up to 35,000 and secured lending up to 70,000. Keeping it pretty simple because the market is young, it's not going to grow that fast, and I'm not a big fan of complexity. I think you need to have a pretty simple proposition in market that people can understand and sort of get their head around.
So up to 70,000 for loans. I mean, I think Harmony's up to about 35 at the moment. So that's quite a bit bigger than what they're doing. What sort of loans would they be, and what will you use as security? Yeah,
look, I guess the difference for us is that because we're an established business already, and we write close to $500 million worth of mortgages every year. We've got a big client base, we've got people that are doing things, and our observation would be in our market, the market that we're dealing in, which is generally homeowners, that there's an opportunity for us to help them with things like house renovations and that sort of thing that would dictate a larger loan size.
Okay, and what about the investors? Who will you target there? And what sort of rates might you be offering, I guess, both for investors and borrowers? Have you sort of crunched the numbers on that yet?
Yeah, look, I think My observation of this market is that investors is actually the easy side of it. I think investors generally understand what's going on, and that they'll do their research and they'll look at the market and they'll chase those higher returns. Let's face it, the returns are good and certainly better than they would get in a bank or even with a finance company with perhaps arguably better risk management than a finance company, not a bank. So the investor side of it, I think, looks after itself, and it is a slow-growing market. So I don't think any peer-to-peer lender has had issue with raising investor funds. Investor funds is the easy bit. So I don't know that we'll necessarily market that side of it hard at all. That will look after itself, and we've got a reasonably visible brand already. And we'll have some very good people in this business that will give investors confidence. I really think it's about the borrowers, and the thing with borrowers is that they're not actually overly rate sensitive. With borrowers, it's all about just getting access to funds when they need it. And that's one of the challenges with the peer-to-peer model is sort of, giving them a pretty much immediate access to money rather than having to wait for a loan to be bidded on until it's full. The borrower side of it's where the issue, so I think a lot of our marketing and a lot of our drive is going to be sort of trying to build up some of that borrower demand so that we can then pass that back to the investors. Typically, I think we're going to be looking at high quality personal lending, generally to existing homeowners, and that's a part of the market that we know really well, and it's part of the market that we're keen to work with. So it'll be high risk. I think a large chunk of ours will be secured versus unsecured.
Secured against their homes?
Well, a loan or a car, probably a caveat lend. And it's just to make it easy, particularly with things like renovations. If you look at the LVR restrictions, it does make it difficult to even do small renovations above 80%. Where we can potentially facilitate that process, make it easier, and at competitive interest rates. I envisage us lending out money at sort of anywhere between sort of 10 and 14%.
Okay, and what sort of credit management are you going to have?
All of the credit management that you would expect from a bank. So we'll have a credit scoring system. We've got a full online process from start to finish, including automated credit scoring and everything else. So once the system's up and running, we should be able to issue an approval in 5 minutes. And then in the back end, we're going to have some different ways of managing that credit risk for investors. We won't be fractionalising the loans. We've got a different process for managing that risk.
Can you tell us any more about that?
Not at the moment.
Okay. You mentioned 10 to 14% interest rates for borrowers. What are you likely to offer investors?
After expected credit losses, I think investors could expect to get probably somewhere between 8 and 10%.
Okay, and you mentioned that you don't see this as a sort of short-term thing that's going to explode in New Zealand and get really big really quick, which is I'd argue certainly a good thing if it doesn't. But over time, obviously, it's got immense peer-to-peer lending's got immense potential. But given New Zealand's a small country, how much space do you think there is for peer-to-peer lending, and how many players could we ultimately see in this market, in a sustainable market?
In a sustainable market. Well, look, I mean, the consumer finance market is reasonably large. You have got low cost of entry, and these platforms aren't overly expensive to develop and maintain. They're certainly not cheap. And you've got big legacy banks that are the incumbents, and so would find it difficult to adjust to this changing market dynamic because it has such a big impact on their long-term profitability. So I think you've got all those dynamics in play that sort of suggest that peer-to-peer will just gradually evolve and form its own niche within the market. We haven't really been through a full credit cycle, and we haven't been through a full credit cycle with peer-to-peer because it's only just come into the market.
Not even in the States or Britain.
Yeah. So look, I think it'll be interesting to see it go through a full cycle and potentially go through a major recession and just see what happens through that part of the cycle. I think these things are all good and well when the market's relatively buoyant and credit losses are really low. The real test of these systems is probably another 5 or 6 years away. And then I think at that point it will be really interesting just to see what sort of future the peer-to-peer industry has. One would argue it's really strong because the sort of disciplines that have been put in place in the industry aren't dissimilar to the sort of disciplines you'd expect from a bank.
Now, we've seen, obviously, Harmoney is the only licensed peer-to-peer lender we have so far in New Zealand. They've had a lot of institutional interest. Heartland Bank buying into the business. They've had a big fund in New York come in and give them money to lend. Are you going to have institutional money as well?
No.
So it'll just be retail?
Mum and dad's. Look, as I said, I just don't think that the market's going to take off fast enough to warrant institutional investors. We'll have a pool of money that's readily available for us so that we can pretty much issue loan offers straight away and therefore keep some liquidity in the market and keep things turning over. But I just don't see the need for institutional money. I don't think the market's big enough. I don't think we need it, and I'd much rather see just regular retail investors getting a good return on their money than that sort of being sucked up by institutional investors.
And I mean, over time, how big do you think your lending book could get?
Good question. I haven't really sort of planned it that far ahead. I certainly think that the market, over the next 5 to 10 years will get pretty significant. It's a bit like KiwiSaver, low margin, low cost of delivery. It takes time, but in 10 or 15 years' time, you'll look back and there'll be an entire new industry, and you'll go, wow. But for the foreseeable future, I think it's it's a reasonably low margin business that's going to take a while to grow and mature.
And obviously the FMA are the regulator overseeing this, so they're the ones that you have to go to try and get your licence. And how's that process been? And how do you think it's being regulated? Is it is it sensible?
Yeah, look, I really like it. I think there was a bit of commentary that it was a bit OTT, but I actually really like the approach the FMA is taking more broadly across regulation. So not just peer-to-peer, but across everything that it's doing, because it's really focusing on governance and ensuring that businesses have really good governance structures and they have the proper and appropriate market discipline to do what they do. It's all about competency. And look, those are all of the things that you would want to see in this sort of market. It's made it harder. It means that it's a more time-consuming process to get to market. But I think the long-term benefits of it are far outweigh the sort of costs of putting those frameworks in place. It certainly makes it more expensive. And if there was a barrier to entry, it's around all of the cost associated with maintaining that level of governance. The benefit for us as an existing business, that governance and compliance is actually good for our broader business. Other aspects that we're looking at, for example, is that we'll QFE the business. And in QFEing the business, we've also got to put in a certain level of governance and compliance. So you could argue that we do the governance and compliance once in the business, but we get quite a wide benefit, both in terms of a peer-to-peer license, for a QFE license. And the other thing that we're looking at in 2015 is potentially listing on the stock exchange.
Oh, really?
In terms of the next exchange, which is the new alternative exchange that they're just in the process of launching at the moment. And all of those things require governance and compliance, and so you do it once, you do it right, and you get the benefit across a whole lot of different aspects of your business. Yeah,
well, that would be an interesting move going on the share market too.
Yeah. But look, I think peer-to-peer is the start. It's the start of a whole heap of technology that's washing into financial services and into banking. And there's going to be lots of opportunities to pick and choose different places to play where you've got, a lot, well, the requirements for capital are a lot less than traditional organisations because, they're web-based.
Yeah, well, it's very much a watch this space. Well, thanks a lot for that, John. That's John Bolton from Squirrel Mortgages and Squirrel Money, and I'm Gareth Vaughan at interest.co.nz.